Good afternoon, ladies and gentlemen. Welcome to this webinar jointly organized by IEA, CIEP, and the IEA. The purpose of today's meeting is to provide an update on global gas market developments with a focus on Europe. This update is very timely, as even for people who work in the sector, it is really not easy to keep up with all the developments lately. I'm here today in my capacity as a scientific advisor of the Italian Institute of International Affairs, IEA, and as an associate fellow for CIEP, Clingendael International Energy Program. As per tradition, I'm joined here today by Kobe van der Linde, the director of Clingendael International Energy Program, who will moderate the Q&A session. And we are here to hear from the experts Jean-Baptiste Debreuil and Gergely Molnar, gas analysts at the International Energy Agency. They will present to us the latest quarterly gas market report. The market continues being tight and volatile. European imports from Russia continued going down in recent weeks after the sabotage of Nord Stream. What we have seen also in the last couple of weeks is that in moments of colder weather, gas demand in Europe has been pretty high, which casts some doubts on our collective ability to limit gas demand this winter, in spite of national and European plans to do so. On a more positive note, storage filling has continued. The filling is now at very good levels, above 90% in Europe. And this is actually creating a sense of comfort, leading many to conclude that for this winter, the outlook is actually quite promising, and that the real problem will rather be next winter, because we will need to fill the storages without Russian gas. Let's all realize that in this injection season, we have filled storages also thanks to Russian gas. LNG imports in Europe continue being very high. The continent is attracting in particular a lot of US LNG that is really making the difference. These changes in supply are transforming flows within Europe. So east-west flows are no longer prevalent, not as prevalent as they used to be, which actually increased in importance the theme of internal congestions within Europe. Of course, when flows go through a reconfiguration, then you can have problems at interconnectors and limited capacity that we didn't know was there before. At a political level, measures to face high energy prices are the object of intense discussions, both in national capitals and here in Brussels. Germany has put on the table a very ambitious plan worth 200 billion euros to shield final users from high energy prices. And this inspired the debate on European solidarity, with the southern member states asking for an EU-wide price cap on gas. There was a letter signed by Commissioners Breton and Gentiloni asking for the establishment of a plan similar to SURE to lower energy costs in Europe and incur new debt to essentially shield final users from these extremely high energy costs. Indeed, the effects on final users of very high energy prices are being felt more and more, and unfortunately everything points to the fact that they will be felt more and more in the next months, as some contracts also at the retail level will need to be renegotiated. At the same time, the IMF is telling us that the outlook for economic growth is not exactly brilliant, so fiscal space is getting more and more limited. And particularly in some large industrial countries that use gas, Germany, Italy, for instance, the fear of recession for next year is looming. At the European level, the European Commission is going to propose a new package tomorrow. We already know what is going to be in it. The plan is going to ask to set up a facility allowing for joint demand aggregation and gas purchasing. I think it's important to highlight that while the platform is mostly going to be voluntary, or the participation in the platform is going to be voluntary, there are some cases in which joint purchase could be compulsory, notably to reach 15% of storage filling objectives in the next season. The package will also likely introduce mechanisms to protect citizens and the economy against high energy prices by way of an ad hoc LNG price benchmark to be developed by Acer, temporary intraday volatility management mechanism for extreme price movements, which will look probably quite a lot like a circuit breaker, and then the development of a so-called market correction mechanism, which looks a lot like the dynamic price cap that have been proposed by Italy, Belgium, Greece, and Poland, but with a lot of pretty stringent conditions attached to the activation of this mechanism. The regulation will also propose to establish a booking and transparency platform for LNG and gas storages and rules on congestion management in gas transmission networks. And finally, it establishes rules for the case of declaration of a gas emergency to distribute gas fairly across borders. So essentially providing for solidarity in default of bilateral solidarity agreements that do not really exist on a large scale between European countries. Member states will certainly amend some of the provisions. A key date to watch is 20th and 21st of October this week with the European Council. So that's it from my side. Let's now turn to our experts to get some facts and figures about what is happening in gas markets and what to expect. I invite all of you to send questions in the dedicated box already now, so that our moderator, Kobe, will be able to collect them and organize them in order to then address them to our experts. Today we have to be time efficient because we only have 1 hour, so I'd kindly ask Jean-Baptiste and Gergely to be as brief as possible. Thanks again, and now I give the floor to the IEA.
Thanks a lot, Luca and Kobe, and thanks to CIEP and IEA for having us again today. Good afternoon, ladies and gentlemen. My name is Jean-Baptiste Dubois, and Senior Gas Analyst at the International Energy Agency. It's a pleasure to be with you today to share some of the findings from our latest quarterly gas market report that was published 2 weeks ago. So to begin with, start with a quick look at price developments since we published our previous edition. Beginning of the summer, we've seen some high turbulence on the different markets, which were translating to a peak in gas prices, both in Europe and in Asia, at the end of August, where prices culminated to about 10 times where they were a bit more than a year ago at the beginning of summer 2021 when the rally started. Prices have moderated since then in September, but they remain both very high and exceptionally volatile, which causes further pressure on market participants, particularly in Europe, for traders and utilities which face high margin call risks and commitments. One quick word before going to the physical impacts of the crisis, to talk about the prices in non-importing region, in a matter of fact, in North America. As you can see on the chart, prices, of course, are not the same level as what we see in Europe or in Asia, but have nonetheless doubled since the beginning of the rally of more than a year ago, with Henry Hub prices averaging $8 per MMBTU throughout the summer on a tense power market situation, which is, by records, its highest summer levels since 2008 and the rollout of the shale gas developments in the US. So moving on to the next slide now, thanks, and to the physical impacts. First on the demand side, well, we have seen across the past months 2 impacts reacting to that high price and tight supply situation. First one is fuel switching, and according to the IEA estimates, there has been already quite a substantial amount of oil burn increasing in power generation and in industry. And our estimate for this winter, for Q4 and Q1 next year, is that we'll see an additional 0.7 million barrels a day of oil being burned in power generation industry as a result of fuel switching away from gas across the different market. Has also prompted an increase in coal-fired generation in different markets, which probably would have happened if we had a more balanced gas situation. On this figure, you see the evolution of demand on the different main markets, whether it be big consuming importing markets such as Europe and major Asian countries, but also on North American consumption. As you can see, the dark blue line, the North American demand is a bit of an outlier. We've seen some growth in the first half of the year, again, which stems mainly from that tight power market situation in the US, also the impact of the phasing out of coal in Western Canada. But in other markets, especially in net importing markets, it's a downward trend, which is particularly exacerbated in OECD Europe, with a 15% decline in the second quarter. If we put together the impact in terms of volumes, and those are the gray bars on the figure, you see that the order of magnitude for Q2, according to our estimate for those four regions put together, is more or less similar to what we saw in Q2 2020, which was a time when the global economic system was suffering from the high impact of the COVID-induced lockdowns. The situation, and could move to the next one, please. Thank you. This situation, if we extrapolate it to the whole of 2022, is having, of course, an impact in terms of overall gas consumption growth. We do expect a contraction in demand, about 0.8% decline, or around 30 billion cubic meters less than last year. Just for the record, the gray bars on this figure show you the increment from 2021 compared to 2020, when we had a 4.5 jump in gas consumption, a strong recovery from the COVID outbreaks of 2020. This year, we see a decline. The bulk of the decline coming, of course, from Europe. As you can see, roughly half of it comes from the industry, with strong demand reaction from the high price environment. We also had some reduction in residential and commercial, which came due to milder temperatures in the beginning of the year. In other regions, one of the key highlights is that we expect Asia Pacific to be stable in terms of demand this year compared to 2021, which is, of course, a major change from that strong raw powerhouse that the region has played over the past years in developing global gas consumption globally. Other markets, you see it's more mixed. Just a quick mention about two net exporting markets, North America and the Middle East. We see some slight expansion. I mentioned already North America, with mainly driven by power generation and the tense situation that we've seen so far, and also to some extent some growth in the Middle East. But all in all, of course, we do expect to see negative growth this year, and only very weak increase for next year, less than 0.5% so far, according to our forecast. Moving to the next one, thank you. Of course, Europe sits at the epicenter of the crisis, and since the beginning of the invasion of Ukraine by Russia in February, we've seen a very steep decline in Russian pipeline deliveries to Europe. As Luca mentioned, now with Nord Stream being taken off, it's now only residual transit coming through Ukraine and also through Turkey. But this has had a major impact on reallocation of global LNG trade across the different markets. This is illustrated on the right-hand side picture. The chart shows you the evolution of LNG demand per main market for the first 8 months of 2022 compared to last year. We see that there's some marginal increase in LNG supply, but there was mainly a redistribution away from Asia, and particularly from non-OECD Asia to Europe, with a roughly 65+% increase in European imports so far this year in the first 8 months of the year. to bridge the gap left by this sharp decline in Russian pipeline flows to the continent. Moving to the next one, thank you. This is a more detailed illustration of that reallocation of flow. If you zoom on the trade of LNG to Asia, one of the main features that Asia was a strong harbor for short-term LNG trading, spot trading, and as you can see, since the beginning of the year, this spot trading has collapsed, particularly in China. In the first 8 months of this year, Chinese spot LNG imports collapsed by almost 60%, and the overall LNG imports from China declined by 20%. China is not, of course, the only consumer of LNG which saw a decline in its imports. It goes across almost all of the emerging Asian markets, whether it be India, Bangladesh, Pakistan, or Southeast Asia, whereas flows to Japan and Korea remain more stable. Behind this decline in Chinese imports, and this is now the next one, thank you, lies the very weak demand, gas demand in China. On the left-hand side, this is the monthly evolution of Chinese gas demand. As you can see, apart from a peak in the first month of the year, we've seen negative growth for most of the year so far. It's a bit difficult to disentangle the impact of high prices compared to lower economic and industrial production. On the one hand, of course, the impact of the zero COVID policy and lockdowns that have been enacted since the beginning of the year. But all in all, according to our estimates for the first 8 months of this year, Chinese gas consumption increased by less than 1%. Our assumption for the whole of 2022, based on the expectation of some progressive recovery, which can be challenged in the light of the most recent new batch of COVID lockdowns that have been announced at the beginning of October, would be that China's gas demand would increase by about 2%, which again can be further revised downwards. By our account, that would be its lowest growth rate since the mid-1990s, and that would be, of course, throughout the year, a strong source of flexibility and volumes redirected to Europe to balance the LNG supply gap. We move now to the next one. So this is the global picture that we have updated in terms of our view for the whole of 2022 incremental global LNG balance. As you can see in the center, we do expect global energy supply to increase by a bit less than 30 billion cubic meters this year, half of it coming from the United States, notwithstanding the impact of the progressive recovery of Freeport LNG, which is still expected to resume partial activity next month, and the other half's coming from improved activity from existing export plants throughout the different producers across the globe. On the demand side, our expectation for Europe this year is to see a 60 BCM increase in LNG imports, which is more or less twice the amount of extra capacity put on the market. And of course, much of that balancing comes from lower imports from Asia, again, China being one of the strong contributors, but other emerging and more price-sensitive buyers also contributing to that, and some contribution also from other regions, namely from Latin America, after last year's drafts, which has led to a surge in LNG purchasing, particularly in Brazil, to bridge the gap left by low hydro. So this is likely to remain a very tight LNG market until the end of the year, and in the longer term due to limited capacity additions. Of course, any temperature-related incidents, particularly in the event of simultaneous cold spell in Northeast Asia and in Europe, will further tighten this LNG balance for the end of the year. Moving to the next one, please. Thanks. One of the features that we covered in the latest edition of the gas market report as part of our global gas security review is the evolution in terms of LNG contracting on a yearly basis. And through that, we track different metrics. You have over there destination flexibility, contract duration, contract size. It's interesting to see that since 2021, and we're now looking at the left-hand side part, the flexibility in new signed contract has dramatically evolved. Until 2019, the bulk of new contract was signed with no destination clause or very flexible terms, the bulk of it coming from US projects with FOB terms. Since 2020 and further increasing in 2021, see that this share has moved back to more restriction on destination. On the back of that, there has been a very strong contracting activity from Chinese buyers in order to reduce their exposure to spot procurement. So far, this has not translated into a very strong tightening of the flows because Chinese buyers have resold cargoes to Europe lately, but is likely to change for the coming winter as the Chinese government is implementing measures to increase its own security of supply for the coming winter. Moving now to the next one, another feature of that changing and tightening global LNG market is also access to new facilities to regasify natural gas, LNG, sorry. And this is illustrated by the tightening market on floating regasification storage units. Those FSRUs, which were initially aiming to unlock new markets in Southeast and South Asia, have now been redirected to European projects in order to ensure new entry points into the European system. On the left-hand side, you can see that the count of FSRU available or on order is roughly about 20 vessels. And if you sum up the number of vessels already firmly dedicated to European projects or likely to be associated to European projects, we're more or less equating the whole fleet available and in order, which means that according to the third column on the right, you see that gray area shows the gap for projects in Asia that were supposed to be fueled by supply coming from FSRUs, which were not firmly contracted and which will create a potential gap into the supply for those projects, and therefore raises a question mark into the development of natural gas in those emerging markets in Asia. With this, I would like now to hand the floor to my colleague Gergely Monnert, who will get you through a more detailed view on the European outlook. Thank you.
Thank you, Jean-Baptiste, and good afternoon. My name is Gergely Monnert. I'm a gas analyst at the International Energy Agency. Many thanks for IEA and CIEP for having us today. It is always a pleasure to discuss recent gas market developments in this traditional gas webinar. In the next couple of minutes, we will focus a bit more on the European picture and on the upcoming heating season. This slide shows how gas supply dynamics evolved in the last 3 quarters into Europe. We see the steep decline in Russian pipeline gas supplies into Europe. It has fallen by approximately 40% year-on-year, translating into a drop of 55 BCM in absolute terms. And we also see that all the alternative suppliers have been ramping up their deliveries into the European market: Algeria, Norway, Azerbaijan via the Trans-Adriatic pipeline. But it has been really LNG which was doing sort of the heavy lifting LNG supply into Europe increased by around 50 BCM in the first 3 quarters of the year, and this has been largely driven by incremental supply from the United States, which solidified its position as Europe's largest supplier of LNG. And also in the 3rd quarter, we have seen that US LNG overtook Russian piped gas supplies into the European Union. This very strong shift in the patterns of imports of gas into Europe has, of course, led to changes on how we are using gas infrastructure across the continent, and it has led to infrastructure congestions and emerging pipeline bottlenecks. On this slide, we show 3 examples of that. One graph is showing how the utilization of LNG regasification capacity evolved in continental Northwest Europe, so including Belgium, France, the Netherlands. And what we see here is that in the 3rd quarter of this year, utilization of the LNG terminals has been at nameplate capacity. We also see that there is a jump in the capacity. This is due to the commercial startup of the new Dutch LNG regas terminal, which added 8 BCM per year of regas capacity into the region. And we also see that immediately as it had been added, it is also fully utilized. The second example is the interconnector between the United Kingdom and continental Europe, which has been also running close to nameplate capacity for most of this year. And the 3rd example is the Spain to France interconnector, which has been several times maxed out during the 2022 summer season. Now, these emerging pipeline bottlenecks and infrastructure constraints are also driving the divergence in local prices across Europe. We have seen that TTF, the Dutch benchmark, has been trading at a significant premium compared to NBP and Spain's MIBGAS. Price differential during the 3rd quarter of this year has been above 50 euro per megawatt hours. And this is partly can be explained by the fact that both the United Kingdom and Spain has a greater access to LNG. They have spare regasification capacity. And the second component is that neither the United Kingdom nor Spain has strong injection needs because of limited storage space in those markets. When we are looking at TTF and the rest of the continental hubs, mainly in Eastern Europe and in Germany, we see that those hubs have typically retained their premium compared to TTF, and this premium is typically close to the transport costs between TTF and those local hubs. The record high gas prices in Europe also led to a steep reduction in natural gas demand. And in the first 9 months of the year, our estimate is that European gas consumption declined by approximately 9 to 10%. And this has been largely due, on one hand, to lower distribution network related consumption. We see this steep drop in the first half of the year, which was partly related to the milder weather conditions. When we are looking at the gas burn in the power sector, it has been quite resilient. And we also see that it actually increased in the 3rd quarter because of the low hydro and nuclear availability in certain European markets. But what is really striking is to look at how industrial gas consumption evolved in Europe, and we see that it declined by approximately 15% year on year. And this is largely due to production curtailments in the most gas and energy intensive industries, such as fertilizers. According to Fertilizer Europe, by the end of August, approximately 70% of Europe fertilizer production capacity faced curtailments. And of course, this could lead to some tensions on the food supply chains in the future. Altogether, we do expect that OECD Europe gas demand will drop this year by around 9%, or 54 BCM, which would be the steepest drop in European history of gas. Now, looking at the upcoming winter, let us start with some good news. And I think both Luca and Jean-Baptiste mentioned that we reached in Europe 90% fill levels by early October. In Germany, the 95% target has been also reached in the last few days. And of course, this gives us a sentiment of optimism. Although I think it is also important to recognize that these storage levels have been reached because of three factors. One, the EU and national targets played an important role in that, but also the markets have been delivering. The very high prices on the European hubs, including on TTF, were instrumental to bring in all the additional energy volumes which were needed for the market. And they have been also, these high prices were also key to give the right signal to the demand side, and which led to, of course, a painful demand destruction, but this demand destruction was needed to save those gas volumes which have been injected into the storage sites. And the third factor is that weather is kind to us. Temperatures since early October has been milder than average, and this also helps some additional injections at this time of the year. Now, of course, we think that there is a need for cautious optimism when looking at the storage levels. We had done some sensitivity analysis on how storage levels could evolve this heating season. In our sensitivity analysis, we have been looking at a case when there is no Russian piped gas supplies to the EU starting from the 1st of November. We developed two scenarios, one with high LNG inflow and one with lower LNG inflow, and three subset scenarios depending on how demand will evolve. One is assuming that there is no demand reduction compared to the 5-year average. The second subset scenario is basically the continuation of prevailing market trends, translating into a demand reduction of 9% compared to the 5-year average. And the third one is a 13% demand reduction compared to the 5-year average. And I think what is really key to note here is that if current demand trends do continue, but we have a winter which is 8% colder than the average, we are basically returning to the sub-scenario where there is no demand reduction. And what we see is that if there is no demand reduction this winter, then it is very likely that EU storage levels will be below 30% fill levels by the end of February 2023. And what are the consequences of that? We are portraying this on this slide. If storage levels stand below 5% their working capacity, it means that we will face widespread gas supply cuts in the event of a late cold spell. And this means gas supply cuts to the industry, to power plants, but also to the public and commercial sectors, and also to the households. If we have storage levels at 15% full, then it is still likely that we will face gas supply shortages to power plants, and then this would of course have implications on electricity supply security. Storage levels at 25% would likely to lead to gas supply curtailments to certain industrial consumers. And then we are approaching this 33% fill levels in the middle, marked as a yellow. Here we see limited risk of gas supply shortages, but of course these are low storage levels for this period of the year, and this would tighten the upcoming injection season. And basically, when we are looking at the range between 40 to 50% fill levels, the green part of the slide, those are what we should aiming for, because at this range we are easing up the 2023 summer market by reducing the injection needs for the upcoming gas summer. One point we would like to note is that, of course, European citizens have their role to play in that picture. According to our analysis, behavioral changes could reduce gas consumption this heating season by approximately 15 BCM, and we described some of those actions in our Playing My Part report we published back in April of this year. This includes measures such as turning down heating by 1 degree, adjusting boiler temperatures, but also be a bit more careful how we consume electricity in our daily life. And one last slide for us to look a bit beyond the immediate short term. What is important here is that 2023 will be a very dry year in terms of LNG liquefaction capacity additions. In our forecast, there will be only 20 BCM of additional LNG supply coming into the market. This is well below what we have seen in the past. And this coincides with a major uncertainty on how Russian pipeline gas deliveries will evolve into the European Union. Assuming that Russian pipe gas supplies continue at the current level, in that case, we would still see a decline of 35 BCM compared to the 2022 levels. But of course, there is downside risks to that, including cut of transit flows via Ukraine, but also a potential cut of deliveries via Turkstream. So there is a huge uncertainty on how much Russian gas will arrive to the European market next year. And at the same time, we see that LNG supply additions will not be able to offset this decline. And this paints a picture of continued market tightness into the coming year. And in this context, demand side measures and doubling down on the efforts related to energy efficiency, deployment of renewables, and also responsible consumer behavior will be key to stabilize markets. Thank you for your kind attention, and now giving the floor to our host, Kobi van der Linde. Thank you.
Thank you very much, Jean-Baptiste and Gergely, for this presentation and reminding us through your slides on how precarious the situation is and how much it depends on weather-related issues, but also the behavioral change that is required, because the more that materializes, the easier it also is, I guess, for some of the Asian consumers who have been, I saw, were pretty much locked out of the LNG market, which, of course, is also a very bad side effect of all this. We have some questions in the Q&A app. One is about, and you mentioned that, Gergely, at the end, about the possibility of Turkey becoming a hub for Russian gas into the European Union. And the question is whether that gas will actually be able to reach deeper into the EU, or whether it will be stuck in Southeast Europe alone. And maybe as a second question, once you've answered that, I think the next question is more towards Jean-Baptiste on the contractual side of things. So we'll come back to that on your one once we had that first answer.
Thank you, Kobi, and thank you for that question. So I think this idea of setting up a hub has been proposed a couple of days ago between a meeting between President Erdogan and Putin. So first of all, the hub is a widely used term in the energy industry, and it is rarely defined, and it can mean very different things. It can mean a sophisticated marketplace where market participants exchange natural gas in a time and cost-efficient manner, and it can also mean just the intersection of gas infrastructure and basically just a place for transiting natural gas. So it is, at the moment, I think it is unclear what has been meant. What I think President Erdogan said that the Republic of Turkey is going to consider this, and they will develop certain concept proposals. So I think it is a bit too early to judge on that. I think one key question is whether there is any offtake contracts underpinning that. Before we go into the technicalities, how it can reach certain European markets, I think the Deputy Prime Minister of Russia, Alexander Novak, mentioned that the supplies can be around 63 BCM. So this rhymes well with the South Stream project, something Russia was pushing years ago. But I mean, it is not only about building up capacities, also about finding the buyers. And I think it would be very difficult to find buyers for that gas in Europe. So then, you know, if we are looking at the practicalities, there is some infrastructure in that region which could be used to channel this gas, but there would be obviously a need to develop additional transmission corridors. But again, I don't think that this question is on the table, because there are some more basic questions about who would be the buyers of that gas, and honestly, I don't see them. Thank you.
Thank you very much. And I think the next question is, Jean-Baptiste, is about what you mentioned on the LNG destination restrictions increasing. And I'm adding a little bit of my own question here, because you at the same time also present how flexible China has been in redirecting flow. So maybe you can enlighten us a little bit more on that issue.
Sure, certainly. Thanks, Kobe, for the question. Well, what we are looking at through this this tracking of the different contracts being signed, of course, we don't have access to all the information that is provided by the contracting parties, so we have to make some assumption, and the methodology was highlighted in previous editions of our Global Gas Security Review. To simplify, we're not really talking about real fixed destination, firm fixed destination contracts, but we're seeing really that the flexibility in terms of options is declining compared to what we saw before 2019, 2020. Before that, the bulk of new volumes were coming from the United States. Those that were FOB volumes, which were providing the greatest array of flexibility and were bought in a large majority by portfolio players. In the past 2 years, and particularly last year, we had limited activity from portfolio players. We saw that Chinese NOCs were accounting for a large majority of procured volumes, which doesn't mean ultimately that those volumes would be completely locked in onto the final market, but there's likelihood that there will be more restriction than purely FOB volumes as we used to see them a couple of years ago.
Thank you very much. We also have a question on the TTF price development. For one thing, why spot is now higher than what did it say, that between spot and month ahead TTF, but also about the remarks or maybe the fixes that the European Commission is looking at on with no new LNG or not much new LNG coming on the market, how that would work if they come with that new benchmark, in the sense that will it help, or is this just something that maybe would help towards 2023? And I also must admit there is one question for the person who posed it, which was on whether Groningen will be opened up, but I'm in two minds whether I'm going to post that. I think the official answer, maybe as a Dutch person, I can say that is it doesn't look like it unless there is an emergency, and that's the official point of view.
So maybe just on the benchmark related question, I think that part of the idea is to bring greater transparency into the market, and you know, we are firm believers that more transparency is great for the functioning of the market. But I just would like to highlight that there is a difference between a price assessment of the LNG floating around the European shores and developing a liquid mature hub. And I think that the difference is very significant. And on a benchmark, which is the result of a price assessment carried out either by a price reporting agency or by a governmental agency, or it's useful. It gives some guidance to market participants, but it is not a place on which market participants are going to hedge. It is not, you know, there is not a forward curve attached to it. So it is an addition to our understanding of the market. So the way, and of course there is a number of proposals at the moment, and these proposals are still being discussed. But I think that this difference should be highlighted in those discussions, and that's just one minor comment I wanted to make around this question. Thank you.
Yeah, thank you very much for that answer. There's also a question which regarding Chinese gas demand and looking forward how that might develop. particularly because what we sometimes seem to forget that last year China had actually quite a serious energy crisis itself, and seemed to be quite keen now on security of supply. And so on the one hand, what you showed is that we've seen a fairly large reduction in gas supplies to China, and perhaps an increase in demand for other fuels. So how do you think that will play out in gas demand, particularly if we also have to factor in decarbonization plans, and how important that would feature in Chinese gas demand? I think Jean-Baptiste, that's your Asia, I think, today.
Yeah, well, there's a lot, of course, uncertainty surrounding the trend for the Chinese economy as a whole, and its impact on energy consumption, gas consumption in particular. Our assumption for our forecast for next year, for the time being, is a relative bounce back, about 5% increase in gas demand in China. This is nothing like the 12% we had last year, but betting on the expectation of improved macroeconomic condition, also on the evolution of the zero COVID policy. Those are the two main uncertainties, I would say, beyond the specificities of the gas market. First one is how Chinese industry recovery path is likely to unfold. You look at the PMI evolution; it's not very buoyant nowadays. And the second one is the impact of the zero COVID policy and how it may evolve in the near future. But with notwithstanding, as you rightly mentioned, COVID, it's also a question of domestic security policy, and whether if China's procurement, however high it may be in terms of prices, may still be flexible in the future. There are some signs that for the coming winter there will be more security-related concerns for a Chinese NOC, but in the longer term, it's also likely to play out. Yeah.
Thank you very much. Well, we have at the end, some more questions are coming in. One is a response to what Greg mentioned, that there is no further Russian supplies coming on through pipelines from November 22. I think that was a supposition on looking forward how the fill up for next year would work. So maybe a little bit because just looking at gas, we just already mentioned with China, also the other fuels are at play. There's also going to be oil sanctions in place on 5 December of this year and 5 February next year. You both mentioned fuel switching as some of the stuff, but do you have any idea how these things might interplay? So very high LNG prices as a result of a market tightness and these sort of measures, maybe that the
Yes, thank you, Kobe, and thank you for the question. So just to avoid any sort of misunderstanding, this is, a scenario we have developed in order to carry out a sensitivity analysis on how strong is the European gas system ahead of the winter season. And in this sensitivity analysis, we added a couple of sort of stress factors. One of them is assuming that there is no Russian pipe gas arriving into the EU, and then we also included, different levels of LNG inflow, and also we spiced it up with a cold spell at the end of February 2023. Yes, and regarding the second part of the question in terms of gas to oil switching, I think that this is a dynamic which we clearly see happening both in the power sector and also in some industries where it is possible. that's, you know, that's a factor which is likely here to stay. If we are, you know, assuming that there is, and I mean, all the indicators are trending towards that direction, that there will be less Russian pipeline supply into the EU. So that's a trend which is likely here to stay. And just probably there is one other question which is directed to my part of the presentation. I will quickly respond to it.
Take it? Yeah.
Yes. So there is this 13% demand reduction. So this 13% demand reduction is in fact the 15% reduction, but in disguise, because there have been certain EU member states which said that they will rather reduce their demand by 7% and not by 15%. So, you know, this moderates down sort of the 15% reduction to 13%. Thank you.
Thank you very much. I must say that if you think about it, then the way you just explained, it worked with the storages and the continuation, I guess, of normal LNG flows also throughout the winter. I hope we don't get a repeat of that really cold spring, which was not very cold, but just took a very long time. That might be a real complication. I vividly remember the impact of that. I think it was last year how that worked out. I think we can just squeeze in one last question. Apart from the fact that the obvious question is whether we afterwards may be allowed to share the slides. We will have to ask you guys after this meeting, and we'll let everyone know. So do you have any insight in how the current situation is impacting on production of Russian gas? Because we've been talking quite a lot about demand, but there must also be an impact on the supply side. If that is outside the realm of your preparation, then just tell me. It's just a last question I saw. But it's also in the longer term interesting, of course, to know whether how that works.
No, that's an excellent question. And, you know, what we see is that Russian gas production is plummeting, and it is mainly impacting Gazprom's production, which was down by 38% year on year in September, which is a very significant drop. And, you know, looking ahead, this trend is very likely to continue, considering what is the outlook for exports and the limited upside potential in the short term from the domestic market. And of course, there is this story about rerouting, reshuffling flows towards the east, towards the Asian markets. Again, here there is no offtake agreement signed between China and Russia for offtake from the West Siberian fields. And even if there is such an agreement reached, it would take several years to build up the entire infrastructure and the capacities to reroute some of the export flows from Europe to China.
Yeah. Well, thank you very much. We've reached a full hour, so we promised we would be snappy about the time this time. And then, of course, this is a very important discussion that we're having after your presentation. And I just well, we're looking forward, maybe with some trepidation, towards the January presentation of what is going on. For now, I would like to thank you, and also giving us the insight what the impact was on other markets than Europe of this big shift in European demand. I think it's very important for Europeans to be aware of that this gas is coming from somewhere. and out of certain contractual relationships. But nevertheless, the flexibility of the market to respond was, on the other hand, also remarkable. So for the gas industry, these are really quite testing times. So Jean-Baptiste and Gergely and Luca, I would like to thank you very, very much for this presentation. I would like to point out that the report can be downloaded in full, including also, I think most of the slides or all of the slides are also in the report. But what we will do is we will provide you with information and a link to that website in case you haven't found it yet. But please read the full report because it is a very interesting read for this quarter. Thank you very much, and I wish you all a good day, and I hope that we can all be at our best behavior in Europe so that we can not claim more than a fair share of what little is around these days. Thank you very much.